Hi, I'm Becky and welcome back to Siren Crypto. Today we're going to expand a little bit on what we were doing with moving averages in the last video. So if you missed that one, you can watch it back, and today we're going to be taking a look at a different way of using moving averages. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk, and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. Let's talk a little bit more about moving averages. In the last video, I talked just about using one moving average to generate buy and sell signals. There are some drawbacks with that, and there is a slightly different way of using moving averages. So let's take a look at that for our strategy session in this video. You remember from last time around, when we have a moving average, let's say we have a 3-day moving average. If the market is falling, then the moving average will fall as well, but it will be slightly above the market price, so it follows the trend lower. If the market goes sideways, it can all get a little bit messy with the moving average and the price crossing over. So here we have our downtrend. The market turns around and the moving average turns around too. Our signals come from, when we're using one of the moving averages, from the crossover like here, and this is probably the best signal where the trend has reversed. The problem is, in a sideways moving market, the price and the moving average will cross to give plenty of false signals. Let's say the green line is a 3-day moving average. One way to filter out some of these weaker signals is to use 2 moving averages. So what we'll do now is use an 8-day moving average. I'm going to add it onto the chart so we can see what that looks like. This is also tracking the price, but because it's taking into account more price data, it doesn't track the price quite as closely, so it's at less danger of getting false signals when the price crosses through. When we're using 2 moving averages, we are actually ignoring the areas where the price crosses through the moving average. Our buy and sell signals come from when the 2 moving averages cross over. So in this example, when the green line crosses above the red line, the 8-day moving average, that's the only buy signal that's generated on this chart. And of course, if the market falls off, then the 3-day crossing below the 8 would be our sell signal. Using 2 moving averages together will give us fewer signals, but hopefully it will filter out some of the messier signals, like the example with the price and the 1 moving average being so close together. So that's the theory behind it. So as usual, let's see how it performed in the real world. We'll stick with those 3 and 8-day moving averages. So let's take a look at a real market and some real signals. We're on TradingView here, and what we have is a daily chart for TRX paired with US dollar tether. Let's add on our moving averages now. Firstly, go to the top of the chart and click on the Indicators tab. In the search box, type in moving average and then choose moving average. Now you will have to do this twice because we're putting 2 moving averages onto the chart. We need to change the length now of those moving averages, so click into the little cogwheel and go to Settings. Go to Inputs and change the length to 3. You can change the colour of your moving average line. If you just click into Style, then choose the colour that you would like, and then you can change the thickness of the line so you can see it more clearly on the chart, and then press OK. Do the same for the second moving average, changing the length of that to 8, and again you can change the colour to your choice. In my case, for the 3 I use yellow, and for the 8 I use a pinky red. So if we were just using the 3-day on its own, it does catch the turns, the major turns, pretty well. But where it can get a bit messy are these sort of areas where the market is going sideways, where we are getting buy, sell, buy, sell, buy, sell. The theory behind adding the second moving average is the idea of taking the trade when the 2 moving averages cross over. The price is important, of course, because it's the price that decides the value of the moving average. But it's when these 2 cross over that we get our buy and our sell signals. Let's change that now to an hourly chart. Now, the moving average on the hourly, the 3 will take into consideration the last 3 hours of price data, and the 8, the last 8 hours of price data. We have several buy signals here where we have the 3 moving above the 8, and we stay long all the way up. And then we sell here on the cross down, and it reverses, so we sell short. You do have to remember the shorter the time frame, the more signals you will get. And here's the most recent signal on this chart. What we had was a buy signal, just here. So hopefully you can see by using 2 moving averages together, it can filter out some of those false signals. It may not suit everybody. Some people, if they're using moving averages, they just want to stick to one and have the price crossing above. However, if you like more of a medium term and less choppy trading approach, then using 2 could be the solution for you. So there we have it, a slightly different way of using moving averages. You can use 2, 3, 4. The idea is to try and filter out some of the choppiness we get when markets are going sideways. So go and backtest this strategy and see if it suits your trading style. Well, that's it for this tutorial. We do have 2 video tutorials on our website and on our YouTube channel called The Hammer and The Trident. They both cover in depth how to successfully trade using moving averages in a super simple way. Now, here's a tip for you. I love anything that saves me time. If you think about the time that you spend trading, you can break it down into a few sections. The biggest section, the one that consumes most of your precious time, will be technical analysis. By that I mean finding potential trades based on whatever strategy you want to employ. 100 Eyes gives us a supremely easy to use and very accurate tool for helping you find those trades and the qualifying conditions without you having to devote your attention to it. Instead of having to manually set hundreds of alerts on TradingView or flicking through countless charts, I just set a few easy parameters on the 100 Eyes platform and it does all that for me. This allows me to focus on the more rewarding parts of trading. The result is I make more trades. More trades means more potential profits. And that's what we want, isn't it? We are here to trade and make better profits. Now, 100 Eyes is not expensive to use and it just worked. It will send you real-time alerts in Telegram. I've made a video all about using 100 Eyes. Just see the link below and start using it now and make your life so much easier. If you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto and I'll see you on the next video. Happy trading!